Welcome to the Explainer. We are officially stepping onto the trading floor today. I'm your desk side mentor from Durga Analytics, and we are kicking off the main event, the Emissions and Carbon Trading Desk Master Program. This is a sequenced journey across 9 modules and 110 chapters, covering everything from what an allowance is to execution, technology, and governance. Just as a quick reminder of our structure, the course is organized into 9 modules plus a primer annex. That primer annex is Module 0, covering chapters 0.1 through 0.14, which we are now leaving firmly behind us. The main modules are Module 1, Running an Emissions Trading Desk, Module 2, Emissions Market Structure that Actually Matters, Module 3, Senior Emissions Trading Playbooks, Module 4, Valuation, Curves and Model Skepticism, Module 5, Risk, Credit, and Survival, Module 6, Execution, Auctions and Operational Risk, Module 7, ETRM for Emissions Desks, Module 8, Regulation, Behavior, and Accountability, and finally, Module 9, Desk Leadership and Legacy. Today, we're diving right into Module 1, Chapter 1, What an Emissions Desk is Accountable for. Here is our roadmap for today. We'll start with a welcome to the carbon desk, look at the 3 accountable ledgers, and build out a compliance position. Then we'll unpack the market inversion trap, explore why the deadline is a gate rather than a cost, and wrap up with desk governance and ETRM. All right, let's jump straight in. Section 1, Welcome to the Carbon Desk. So if you've ever traded gas or power, you know the drill, right? You're used to being measured on P&L, you're bounded by credit limits, conduct rules, the usual stuff. But treating carbon like just another typical commodity, that is a massive, critical mistake. Why? Because a compliance desk's largest exposure is actually created by a regulator measuring a chimney, not by a trader actively choosing to form a market view. The desk literally cannot decline this position. They can't size it down, and there is no way to exit it by just selling. They can only discharge it. And they have to do it by a specific date using a specific instrument through a highly specific designated registry account. That one fundamental reality changes absolutely everything about how a carbon desk has to be governed. Moving on to Section 2, the 3 accountable ledgers. To govern an emissions desk correctly, a desk head actually has to run 3 entirely distinct ledgers simultaneously. Mashing them together, total recipe for disaster. Think about what happens with a classic compression failure on a dashboard. Say the economic ledger is green because, hey, we're making money, but the compliance ledger is amber, meaning we still have an open obligation. And the funding ledger, it's flashing red with margin outflows. If you try to compress all of that into a single red, amber, green indicator, you end up hiding the specific unit of account, and worse, you delete the exact reading that should trigger a crucial, timely intervention. A single symbol simply can't carry 3 different truths. We hammer this into our risk managers constantly. You simply cannot infer the valid discharge of a statutory obligation from the economic outcome of your positions. They speak entirely different languages. The economic ledger is asking, did we make money? And its unit is always currency. The compliance ledger, on the other hand, is asking, how much of our legal obligation is covered by eligible units in the correct account? Its unit is allowances and status. A risk control stated in currency cannot and will not bind a volume exposure. Okay, Section 3. Let's talk about building the compliance position. Let's see how this actually builds on a real desk using our reference installation for the program, River Power and Heat. You start with a raw exposure, in this case, just over 1 million tons of verified emissions. From that massive number, we subtract the free allocation the installation receives, which is roughly 261,000 EUAs. The difference between those 2 numbers is your true exposure. And here's the kicker. Every component here can move independently. That's exactly why your shortfall is honestly just a forecast until the compliance year is officially legally verified. So doing the math, that leaves River Power and Heat with a net annual shortfall of 750,000 EUAs. Now, notice something interesting. This specific plant receives free allocation covering roughly 26% of its emissions. but the scheme-wide average for the industry might be way higher, maybe 47%. If a modeling team just assumes the industry average, or worse, treats last year's allocation as this year's input, well, that is the single most common way a forecast utterly fails before a single trade is even placed. Free allocation is a dynamic, evolving determination, not a static copy-paste from last year. Section 4. We need to talk about the market inversion trap. Imagine we apply a single market event, say a sudden €6 price rise, to two paired desks. Both desks are holding the exact same volume of 750 lots. One is a compliance desk, one is a speculative desk. Now, the economic ledger reports a €3.6 million gain for both of them on their held inventory. High fives all around, right? Not quite, because the compliance desk just saw its remaining unfunded obligation aggressively reprice. They now have a €900,000 adverse residual cost. Any risk control system that reads both books through the exact same limit framework is going to give the dead wrong answer to one of them. And trust me, it's usually the compliance desk that pays the price. As we say on the trading floor, identical arithmetic, opposite instructions. The exact same market math is telling the speculative desk, hey, relax, you can take a profit, or just hold your position. Meanwhile, that very same math is absolutely screaming at the compliance desk that their remaining hurdle just became drastically more expensive and they need to accelerate their buying right now. This brings us perfectly to Section 5, the gate, not the cost. Listen, we have to fundamentally reframe how we view the compliance calendar. A surrender deadline is not a distribution that you can just casually model in a spreadsheet. It is a hard statutory gate. Looking at the EU ETS calendar, you're dealing with immovable reality. March 31st, verified emissions reported. June 30th, free allocation granted. September 30th, the surrender gate. A market exposure has a normal distribution that you can trade off against expected returns. But a gate just has a status. It's either surrendered or it's not. You can't hurry it along with commercial urgency, and you sure can't negotiate it away with the regulator. When you actually look at the time between those dates, you'll spot a critical 91-day window. Between June 30th and September 30th, the desk knows its gross obligation from the verified report, but they are very often still estimating the final free allocation. For 3 whole months, the desk knows the numerator, but is forced to guess the denominator while the clock aggressively ticks down. This is, without a doubt, the most undergoverned period on the entire calendar, and frankly, it's exactly where the majority of reporting failures happen. Missing that gate is catastrophic, though it looks a bit different depending on your jurisdiction. Miss the gate in the EU? They hit you with a massive cash penalty, plus a make-good requirement to still surrender the allowances anyway. So a missed gate effectively costs you about 2.47 times the cost of just buying the units on time. But California? Oh, California is brutal. They demand 4 allowances for every one that you missed. That means in a rising market, the situation violently worsens both the penalty and the cure at the exact same time, handing you a massive 4x escalation multiple. No desk survives that gracefully. Let's wrap things up with Section 6, Desk Governance and ETRM. To survive everything we just talked about, you absolutely must build the correct architecture into your energy trading and risk management, or ETRM, systems. A standard, vanilla P&L system simply does not hold the metadata you need to run a statutory compliance obligation safely. A desk-grade ETRM needs very specific dimensions to cleanly separate a speculative position from a compliance exposure, and a financial mark from a true legal discharge. For example, an EUA and a California allowance are not interchangeable, no matter how economically correlated they might seem. Furthermore, a registry transfer can complete perfectly in the system without actually discharging the compliance obligation. If your software only models financial positions, it's going to falsely report both of these states as done, leaving you dangerously exposed. And finally, when it comes to the actual governance of the surrender process, I want you to remember one golden rule. Name a human, not a function. Unlike almost every other control on the desk, which can usually be owned by a broader treasury or risk department, verifying surrender evidence must be assigned to a specific, named individual. If you assign it to a vague department, you're just inviting the diffusion of responsibility. You'll end up with 3 different functions all assuming somebody else did the final registry clicks. So as we wrap up this explainer, I want to leave you with a thought. Go look at your own screens today. Is a blended status hiding your next vital surrender trigger? As we get ready to move into Chapter 2, really ask yourself how your system actually reads the difference between a market position and a true statutory exposure. Because getting that wrong doesn't just mean taking a minor P&L hit, it means failing the date entirely. Think on that, and I'll see you in the next chapter.
Welcome to The Explainer. I'm your host and lead consultant from Durga Analytics. If you're joining us, you already understand that running an emissions desk really means living in 2 completely different worlds at once. You're sitting on both sides of the auction and the bilateral trade. On one hand, you're running compliance books against hard, statutory surrender deadlines, and on the other, you're managing speculative carbon books against a purely commercial view. In this master program, we're diving into exactly how that's done in the real world, from the actual trading mechanics all the way to the ETRM systems that hold the whole shebang together.
Just as a quick reminder of our overall sequence journey, this program spans 9 modules and 110 chapters. Keep in mind, our primer annex, that's Module 00, covering chapters 0.1 through 0.14, sits right before Chapter 1 and actually isn't counted in that 110 total. Right now, we're squarely in Module 1 focusing on Chapter 2.
So, let's get into Chapter 2, Compliance versus Speculative Emissions Desks.
Today, we're looking at a scenario with an identical instrument and an identical quantity, but governed by entirely opposite control regimes. We're going to explore what it actually costs a firm to pretend those regimes are exactly the same. Here's our roadmap for this explainer. We'll start with why purpose is a hard data field, see what standard market risk controls miss, prove how selling can literally increase your risk, price out the operational cost of shared limits, differentiate banking from carry, and finally look at how regulators enforce this very same divide. Okay, let's dive into this.
First up, purpose is a data field.
Our fundamental thesis for this chapter is pretty straightforward, but it is absolutely crucial. The compliance desk holds a position because of a statutory gate. Basically, a regulator went out and measured a chimney. The speculative desk, however, holds a position because a mandate permits a commercial view. Notice how the identical 750,000 EUAs at the exact same price are branched by the purpose code into entirely different logical paths. It's not just some fluffy, descriptive policy label for management. It is the pivot point for how risk, governance, and capital are deployed.
And this brilliantly illustrates the real-world operational divide on your ETRM system. For the compliance book, the control unit is EUAs and gate status, complete with a hard deadline, a gate, on September 30th. For them, selling inventory actually raises risk. But conversely, the speculative book has no gate. Its control unit is currency, and for them, selling reduces risk. Purpose is a hard controlled data field that dictates absolute opposites in how the desk behaves.
Moving on to Part 2, what VAR cannot see.
Let's see how this builds into the mathematics of risk. What actually happens when we apply a standard trading control, like value at risk, to a compliance book? Now, what's really interesting about this is the massive disconnect it reveals. A standard one-day 95% VAR on our 750,000 EUA a reference position reports a risk of 1.26 million euros. That looks comfortable, right? It's just about 10.5% of the annual risk budget. But look at the other side of the equation. The desk actually faces a 51 million euro cost to close the obligation gate.
Let that sink in.
That means the actual decision exposure to close the gate is 40.53 times larger than what a one-day 95% VAR reports. It's not that VAR is mathematically wrong. It's just answering a completely different question. Remember, a surrender deadline is a gate, not a cost. It has a status rather than a distribution. So applying a daily currency volatility metric completely misses the 51 million euro reality of statutory readiness.
Let's look at part 3. Selling can increase your risk.
This brings us to a frankly mind-bending reality for traditional traders: risk inversion. Let's give both desks the most basic instruction in trading. Reduce your position by 150,000 EUAs. Trace the literal X shape we're looking at here. As we sell 150,000 EUAs, the line representing market exposure goes down, meaning we remove 10.20 million euros of exposure. A standard risk report will pat you on the back and congratulate you for de-risking. But look at the compliance line. The cost of the open obligation that you still need to source actively goes up.
Let's break down exactly what just happened. For the speculative desk, selling lowered risk. Simple enough? But for the compliance desk, selling off those units doubled their open obligation from 150,000 to 300,000 EUAs. Their shortfall closure plummeted from 80% readiness down to 60%. By selling inventory, the compliance desk actively increased its gate exposure. If your firm only runs a market risk report, you have literally installed an incentive to drive your compliance desk further away from readiness.
Which leads us perfectly to Part 4, the cost of shared limits.
So what is the cost of ignoring this? We know firms absolutely love standardizing governance. It's cheaper to build, it's easier to audit. But let's look at the operational reality of applying a single limit framework to both of these books. A single framework has to be calibrated to one of the two. If you choose option A and calibrate to the trading book's delegated authority, the compliance desk is forced through a brutal administrative nightmare just to meet its statutory obligations. But if you choose option B and calibrate to the compliance book, well, you just handed the trading desk 4.25 times their intended risk budget.
Lean into the absolute absurdity of that first option for a second. 43 separate approvals. If calibrated to the trading book, the compliance desk has to secure one approval every 4.26 days for 6 straight months, assuming no holidays or rejections, just to close a mandatory non-negotiable regulatory gate. At that point, you're not governing the desk, you're metering it to death.
Let's jump to Part 5. Banking is not carry.
Let's move to another core trading mechanic to see how this divergence continues. We'll look at funding rates and the concept of carry to prove, once again, how identical trades behave entirely differently depending on the book. Take a standard spot versus forward trade with a spread of 3.50 euros. On the speculative book, this is a classic carry trade. It crosses zero at a 5.15% funding break-even. If funding goes above 5.15%, the speculative desk simply exits the trade. But look at the compliance line. It remains perfectly flat. Why? Because the compliance desk isn't choosing between holding an asset and holding cash. They are choosing between pre-funding an obligation they will absolutely certainly have and refusing to pre-fund it.
So the crucial point is this. Applying a standard speculative funding hurdle to a compliance desk does not manage risk. Instead, it systematically forces the compliance desk to defer their pre-funding. It takes a visible, easily understood funding cost and silently converts it into massive, hidden deadline risk at the regulatory gate.
Finally, Part 6. Regulators draw the same line. Now you might be wondering, is this just some internal corporate governance theory? Absolutely not. This is exactly how market regulators enforce registration mechanics in the real world. Take the California Cap and Invest program. Under Section 95920, California imposes a strict holding limit specifically to restrict speculative capacity. To get an exemption and hold the large volumes required for compliance, covered entities must physically place those allowances into their specific compliance account. By locking them in that account, they are held for statutory surrender and are no longer available for trading.
Both major regulators charge the desk to cross the line between speculative and compliance. California uses a physical account barrier, which costs the desk its optionality. The EU uses an evidence standard, requiring positions to be objectively measurable as reducing commercial risks, which costs the desk a massive burden of documentation. A purpose code that cannot be reconciled to an obligation record is not evidence, it's just an assertion to a regulator.
Which brings us to the core takeaway for ETRM professionals and desk managers. You can absolutely share your escalation ladders and governance processes, but you must state the limits in the native unit of each book's exposure, currency and VAR for the speculative book, and physical allowances and gate status for the compliance book. Standardize the method, not the answer.
Leaving you with this provocative thought to ponder. If purpose changes absolutely everything about how we measure risk, how do we physically structure the ETRM accounts to handle it without breaking the firm? That brings us to the end of Chapter 2. Next time, we'll take these control regimes and map them directly into the registry architectures in Chapter 3. I'll see you there.
Hey everyone, and welcome back to this explainer for the Emissions and Carbon Trading Desk Master Program. As a consultant at Durga Analytics, I've spent years in the trenches running both compliance books against statutory surrender deadlines and speculative carbon books against a market view. I've sat on both sides of the auction and the bilateral trade. I've designed the ETRM systems that hold these positions, and I've taught these exact concepts to traders and risk managers just like you. Now, before we jump in, just a quick reminder on where we are in the course. This complete master program spans 9 modules and 110 chapters, plus that primer annex numbered 0.1 through 0.14 that sits right before Chapter 1 and actually isn't counted in the 110. Today, we are diving deep into Module 1, Chapter 3, Asset-Backed versus Portfolio Trading.
Okay, let's dive into this roadmap for today. We're going to cover compliance versus speculative desks, deriving the switching break-even, how price cuts the obligation, how allocation levers volume risk, and we'll wrap up with the hedge ratio dilemma. So Section 1, Module 1, Chapter 3, the asset-backed obligation.
Let's move right into Section 2, compliance versus speculative desks.
Think about it like this. If you're on a speculative portfolio desk, your quantity is entirely exogenous. It's an exact number based on a trade you just executed. If you bought 100,000 allowances, well, you hold 100,000 allowances no matter what the market does. But on an asset-backed compliance desk, it's a completely different ballgame. Your position is endogenous. You are managing a statutory obligation against a hard surrender gate. You actually don't know the exact number yet. That obligation is produced by a physical power plant that responds to weather, to demand, and crucially, it responds to the carbon price itself. The very price you're hedging against actually changes the quantity you need to hedge.
Section 3, deriving the switching break-even.
Because our quantity isn't fixed, we have to know exactly when our physical plant is going to change its behavior. Any senior carbon trader needs to be able to derive this from scratch, so let's hit the whiteboard. It's 4 clear steps. First, we convert our baseline emissions factors into thermal megawatt hours. Second, we convert that into the carbon intensity of the actual electricity produced. Third, we isolate the fuel leg of our marginal cost. And finally, step 4, we calculate the exact carbon price where a dirty coal unit and a cleaner gas unit have the exact same marginal cost. Now, this table locks in our standard conventions for the rest of the program. After doing the conversions for a 38% efficient coal unit and a 50% efficient gas unit, we get our vital numbers. The coal unit emits 2.2188 times as much carbon per megawatt hour as the gas unit. That leaves an absolute intensity difference of 0.492291 tons per megawatt hour. That tiny decimal right there, that is the engine of our entire carbon desk strategy. Now, what's really interesting about this slide is the intersection.
By factoring in fuel costs, the marginal cost line for coal and the line for gas perfectly cross at a carbon price of €71.20 per ton. That is our fuel switch break-even. Below that price, coal is cheaper to run. Above it, gas takes over. Look closely at where our current spot price sits, €68 flat. We are sitting right on the precipice, just barely below that break-even.
Moving on to Section 4. Price cuts the obligation.
In most standard trading, price and volume are independent variables. But watch what happens here. If the carbon price moves from our spot of €68 just up past that 71.20 break-even, boom, it's a dramatic step function. For the portfolio desk, their ledger is static, just a flat line. But for the compliance desk, the physical plant immediately switches from burning coal to burning gas. Our compliance desk sees its carbon obligation completely collapse, halving from 750,000 EUAs down to just 321,706 EUAs. A tiny 4.71% price move just destroyed 57% of our volume.
Section 5. Allocation levers. Volume risk.
Let me ask you a direct question. Does free allocation cushion your volume risk if your plant suddenly has to run harder and produce more output? As a consultant, I see this mistake being made all the time, and it literally costs desks millions. The sharp answer is no. It absolutely does not cushion the risk. It actually levers it.
And here is the mathematical proof. Because free allocation is a fixed subtraction from a growing quantity of emissions, it acts as pure leverage. Look at our reference installation, River Power and Heat. They have a 25.85% free allocation. Because of that fixed offset, a 1% rise in their power output actually moves their compliance obligation by 1.35%. Think about that. The more free allocation you have, the more violently your remaining shortfall swings when output changes.
And it gets even more dangerous because of regulatory realities like the EU's stepped adjustment deadband. Under EU rules, if your production increases, you don't actually get more free allocation unless you breach a 15% threshold. So imagine your plant's output rises by 14%. You are trapped right inside that deadband. Your allocation doesn't increase by a single unit, but your emissions skyrocket. For our reference plant, that 14% output rise adds over 141,000 EUAs to their obligation. At a €68 spot price, that completely destroys 80% of their annual risk budget. And get this, not a single market price even moved.
Which brings us to the absolute golden rule of compliance trading. The surrender deadline is a gate, not a cost. It cannot be hurried by commercial urgency. When you owe statutory allowances to the registry, you cannot trade off that compliance against a better financial return. Regulatory mechanics, like that deadband we just saw, those are your first-order exposure. They set the absolute reality of your desk, not a scenario overlay. Finally, Section 6. The hedge ratio dilemma.
We need to unlearn perhaps the most dangerous assumption of all, the idea that 100% hedge is inherently a safe hedge. 29.12 million euros. I really want that number to sink in. That is the massive, unwanted speculative length generated by a well-intentioned 100% compliance hedge if your asset switches fuels. If you blindly bought 750,000 allowances to cover your initial forecast, and then the price rose and your plant switched to gas, well, suddenly you only need 321,000 allowances. You're now holding over 428,000 allowances you do not need, without a mandate, without a stop loss, and entirely by accident.
And this brilliantly illustrates the exact matrix of the problem. If you hedge 100% of your forecast, sure, you're perfectly safe if the plant runs on coal. But you create a €29 million speculative disaster if it switches to gas. Because of this, setting a hedge ratio on an asset-backed desk is always contingent.
For this specific plant, a ratio of 42.89% might actually be the mathematical no-regret ratio to avoid catastrophic overhedging, no matter which fuel the plant ends up burning.
Hedging 100% of your forecast might just turn your boring, safe compliance desk into a massive speculative long position by total accident. It's a structural trap that has blown up seasoned trading desks time and time again. So the ultimate question is, how do we actually govern that kind of latent, explosive risk? How do we build the ETRM systems, the limits, and the mandates to actually survive it? Well, that is exactly what we're going to tackle in Chapter 4. I'll see you there.
Hey everyone, and welcome back. I'm your host and lead consultant from Durga Analytics. And in today's explainer, we're tackling a topic that strikes right at the very heart of how risk is managed, or honestly mismanaged, in our industry. We are going to expose the incredibly dangerous illusion of currency-based limits on a carbon desk. Whether you're an aspiring carbon trader, a compliance manager, or an ETRM professional, understanding who truly has the authority to act and why is what separates a desk that survives from one that fails.
So let's just do a quick reset on where we sit in the Emissions and Carbon Trading Desk Master Program. As you know, the course spans 9 modules, plus our Carbon from Zero Primer Annex. Those are chapters 0.1 through 0.14, which sit before Module 1 and aren't counted in our main 110 chapters. Today, we are squarely in Module 1, Chapter 4, Senior Trader versus Junior Trader Authority. Here is today's analysis framework. We'll be looking at the dual desk lens, the approval chain fallacy, finding optimal authority limits, why currency authority drifts, measuring the wrong axis, and finally, redefining senior trader authority. Okay, jumping right into Section 1, the dual desk lens. To really grasp desk risk, we have to look at the two massive forces shaping our ETRM systems.
We absolutely must view everything through this dual desk lens. You've got the compliance desk on one side, which acts against a statutory gate. Remember, this gate is binary. It's a surrender deadline that has a strict status, not a distribution. It can't be traded off against a return, and it definitely cannot be hurried along by commercial urgency. Then you have the speculative desk, which holds a position based entirely on a market view. And here is the kicker. The exact same market event frequently pushes these two desks in completely opposite directions. A sudden price spike, well, that's a massive win if you're holding a long speculative view, but it's an absolute nightmare for an uncovered compliance shortfall.
Let's move to Section 2, the approval chain fallacy. This is where standard corporate intuition completely falls apart when designing risk controls.
Let's just state this plainly. In our modeled reference case, closing our statutory gate under a standard granted authority of 1.2 million euros requires 43 separate consecutive approvals. Now you might be thinking, hey, our approvers are great, they have a 99% success rate, but the math is entirely unforgiving here. If your currency threshold forces 43 consecutive approvals, and each one is 99% reliable, your entire chain only succeeds 64.91% of the time. That leaves you with a massive 35.09% failure rate against a statutory gate. Think about that. We're talking about a binary status failure. No amount of yelling across the trading floor or commercial urgency can fix that. Nobody deliberately sets out to design a 35% failure rate, but it happens silently when you combine a prudent-looking currency threshold with a massive compliance obligation.
And honestly, it gets worse. If we add the mandatory external registry 4 eyes requirement, which both major registries impose, in which you simply cannot waive through internal delegation, the chain doubles to 86 events. Your success rate just collapsed to a terrifying 42.13%. More than half the time, this process is mathematically doomed to fail on paper.
Section 3, Finding Optimal Authority Limits. So, how do we actually fix this?
The instinct is usually, well, I'll just delegate more authority to my traders to reduce the approvals. But there's a structural flaw.
Because the annual risk budget for our reference desk is only 23.53% of the total cost needed to close that statutory gate, even if you delegated 100% of your entire risk budget to a single trader's authority, you'd still hit an irreducible floor of 5 approvals. Delegation moves you along the curve, sure, but it cannot pull you off it entirely.
And that brings us to this mathematical crossover point. On one side, you have expected execution costs from approval chain failures. On the other, governance exposure, basically the largest single unapproved commitment a trader can make. If you are to the left of this exact crossover, you are literally paying more in execution risk than you're saving in governance.
So the crucial takeaway is this specific number right here, 1.645 million euros. That is the math you use to defend your position at an interview or to a risk committee. The defensible delegated authority is exactly 1.645 million euros, or 13.71% of the risk budget, not the standard 10% that usually gets arbitrarily handed out. You don't just walk in and ask for more authority. You show them exactly where these curves cross.
On to Section 4, why currency authority drifts. Because just fixing the number to 1.645 million, that doesn't actually solve the core structural flaw of denominating that limit in euros in the first place.
You see, a currency limit governs an exposure that moves. Let's say a fuel switch at your installation drops your central exposure shortfall from 750,000 allowances down to about 321,000. That exact same 1.2 million euro authority suddenly loosens by 2.33 times in relative terms. It goes from governing roughly 2.3% of your exposure to nearly 5.5%. And it does this entirely on its own, without a risk committee deciding a single thing.
When we break down how we denominate these limits, the problem is glaring. A limit denominated as a percentage of your forecast is self-adjusting. A limit in allowances drifts only with price. But a currency amount, that drifts with both price and quantity. It is literally the absolute worst denomination you could use for a moving compliance obligation.
Which brings us to Section 5, measuring the wrong axis. This is probably the single most dangerous blind spot on any carbon desk today. Conventional authority matrices classify risk by magnitude. They assume big money automatically equals big risk.
Imagine we need to do a purpose code reclassification. We're moving over 428,000 EUAs between the compliance book and the speculative book. Because no money is actually changing hands externally, the transaction value is technically zero. So, a magnitude-based matrix means this massive, nearly 29 million euro risk exposure just drops right into a junior trader's lap with absolutely zero required approvals. Crazy, right?
The disconnect here is just staggering, axed with massive consequence. Like surrender submissions or shifting millions between internal books often have tiny or zero transaction values, so they completely bypass standard currency controls. Meanwhile, a routine purchase that happens to be just €1 over the limit triggers a massive chain of approvals. We are measuring the wrong axis entirely.
Section 6. Redefining Senior Trader Authority. To fix this desk, we have to fundamentally rethink how we classify authority. We need to base it on irreversibility and status rather than just transaction size.
True seniority isn't just having a €5 million limit instead of a €1 million limit. True seniority is owning these 3 specific classes. First, status changes that alter the gate reading, like a surrender submission. Second, irreversible acts with no return path, like a California compliance account transfer. And third, book crossings, those purpose code transitions that fundamentally change the nature of the obligation, regardless of how big or small they are. This one sentence right here, this is our golden rule for desk governance. It perfectly captures the actual real-world structural risk profile of an emissions trading desk. A junior manages currency inside a bound. But a senior? A senior guards the gate, the irreversible exits, and the boundaries between your books. We've seen today that simply delegating more authority can't solve the math of a massive compliance obligation. So I want to leave you with a question to ask yourself when you look at your own desk tomorrow morning. If a statutory obligation completely overwhelms your desk's risk budget, is it even a call on the risk budget in the first place? How we restructure that reality is exactly what we will be formalizing in Chapter 5. Thanks so much for joining me on this explainer, and I'll see you in the next chapter.
Welcome back. I'm your host, and as an emissions and carbon trading desk consultant here at Durga Analytics, I spend my days doing exactly what we're going to dissect in this explainer, running compliance books against statutory surrender deadlines and running speculative carbon books against a view. Today, we're diving into Chapter 5, Desk Mandates, Capital Allocation, and Risk Budgets. This chapter is absolutely crucial because we are going to completely dismantle a highly dangerous industry norm. We're going to talk about why managing an absolute compliance obligation with a speculative risk budget is a recipe for disaster. By the end of this, you'll know exactly how to separate the capital your desk must be able to pay from the capital it is allowed to lose. Just to ground ourselves before we jump in, here's a quick look at the wider Emissions and Carbon Trading Desk Master Program. We're moving through a sequenced journey of 9 modules and 110 chapters, covering everything from market structure and model skepticism right through to ETRM technology and governance. And remember, the Module 00 Primer Annex, which covers Chapters 0.1 through 0.14, sits right before Chapter 1 and isn't actually counted in our main 110-chapter journey.
Here's our agenda for today. We'll start with the great category error, move into sizing the funding envelope, navigate the margin call trap, look at why you need 3 mandates instead of 1, and wrap up with ETRM and scheme realities. Let's get to it.
Section 1. The Great Category Error.
A normal trading desk is generally handed just one number to answer a single question. How much are you allowed to lose? That's your risk budget, owned by the risk committee, and its failure mode is simply a P&L drawdown. But a carbon compliance desk? It faces a second, vastly different question. How much must you be able to pay and by when? You see, the statutory surrender deadline is an absolute gate. It has a definitive status. It is not a distribution of loss. So we have this entirely separate pool of capital called the funding envelope. It's owned by Treasury, and its failure mode isn't a drawdown. It's missing a statutory gate. Giving a compliance desk just one number doesn't simplify governance. It completely ignores the regulatory reality you are operating in. Just look at the sheer visual mismatch on this slide. Using our reference portfolio, we're looking at a massive funding envelope of 67.5 million euros, standing right next to a risk budget of just 12 million euros. Asking a 12 million euro risk budget to somehow govern a 67.5 million euro statutory obligation is structurally flawed from day one. It's quite literally like asking a rowboat anchor to hold a battleship steady in a storm. It's just not going to work. Let's break down the math for a second. That envelope is exactly 5.625 times larger than the risk budget. So think about what this means in practice. A firm that grants only a risk budget to a compliance desk has effectively provided just 15% of the capital that desk actually needs to do its job. And even worse, they're asking that tiny 15% allocation to somehow govern the other 85%.
Section 2. Sizing the funding envelope. So how do we properly size this thing? Well, an envelope has to cover the worst plausible cost of discharging your obligation, not the expected cost. Expected cost is just a planning number, and if you size your capacity to an expectation, you're going to run out of cash half the time. We base this on hard evidence. Let's take our inherited shortfall of 750,000 EUAs. At a spot price of 68 euros, our cost at close is 51 million. But we can't stop there. We have to calculate using the observed January 2026 high of 90 euros per ton. That gives us our 67.5 million euro envelope, establishing a strict, auditable 32.35% buffer over the spot price. And this number automatically updates itself as the price record extends.
Section 3. The Margin Call Trap.
Now, a funding envelope isn't a static number. It's a capacity over time, and your execution route changes absolutely everything. If you buy EUAs outright, you consume cash linearly throughout the year. Simple, right? But if you choose to hedge with cleared futures and take delivery at the gate, you defer almost all of that principal. Sounds great. However, it quietly creates a massive peak margin call of 9.12 million euros. That single margin call consumes over half of your available 18 million euro liquidity headroom before a single allowance is even delivered to your account. And here's the kicker. No standard risk report is ever going to show you this.
And this illustrates a truly terrifying asymmetry. That massive margin call, it arrives when the price falls. Think about the irony here. This severe cash crunch strikes exactly when your compliance desk is technically beating its benchmark and doing well. You can be completely right about the market, perfectly comfortable inside your risk budget, and still be completely out of cash to actually fund your gate.
Section 4. 3 mandates, not 1.
To survive this, we have to translate this theory into operational governance. A single mandate simply cannot authorize activities that differ so wildly in their discretion. You have to explicitly separate 3 different mandates. First, the statutory obligation mandate, and listen closely. This must never carry a committee-imposed size limit. Why? Because a regulator measuring a chimney has already set its size. You can't debate it. Second, you have the hedging mandate, which allows you to pre-fund that obligation ahead of the gate. And third, the view mandate, which is your speculative book bounded by your risk budget. If your desk's mandate just says, you may hold no more than X, without distinguishing compliance from speculative use, your mandate is broken.
Which brings us to a massive structural flaw I see all the time in capital allocation: applying return on risk capital, or RORC, to a compliance book. It's a total category error. You simply cannot compare a return on capital that is genuinely at risk with a cost avoided on capital that was never actually at risk in the first place. That compliance envelope was always going to be spent. It's a statutory reality.
Measuring compliance activity with this metric is downright toxic. It makes the desk look like it's consuming a massive amount of capital while producing basically zero return, which effectively starves the desk of the funds it needs. So, how does the desk respond? Rationally. They defer pre-funding. They convert a manageable funding cost today into extreme deadline risk tomorrow. As a consultant, I see this constantly. An arbitrary treasury funding hurdle directly creating massive operational risk right at the surrender gate.
Section 5. ETRM and Scheme Realities.
How does this map directly into your systems? Well, your treasury strategy is going to look vastly different depending on the jurisdiction you are trading in. Take California, for example. The California Cap and Invest program is bounded. It features a hard statutory price ceiling, set at $102.52 for 2026. This acts as a computable maximum. Treasury can size the envelope once and be certain. But contrast that with the unbounded EU market. Sure, the EU has a market stability reserve, but that's a supply response, not a hard price cap. So the EU operator has to size their envelope on evidence and constantly revisit it as the market moves. To actually make this operable day-to-day, your ETRM system has to fundamentally treat the funding envelope as a first-class limit object. It needs to be completely separate from your risk limits. Mandate types must be attached to every single position, not just thrown in as simple purpose codes. And most importantly, your gate readiness reserve, that critical chunk of capital reserved to clear the final hurdle, must be aggressively earmarked so that it actively survives any internal cash netting.
Now that you've separated the capital you must pay from the capital you are allowed to lose, you finally have the architectural foundation to actually survive the gate. Next up, in Chapter 6, we are going to put that exact architecture to the ultimate test by trading the auction. But before we get there, I want to leave you and your operations team with this pressing question.
Is your ETRM system quietly netting away your critical gate reserve into a general corporate cash pool right now? Because if it is, you are flying completely blind into your compliance deadline. See you in Chapter 6.
Welcome back to this Durga Analytics Explainer, where we put on our desk consultant hats to tackle Chapter 6 of our master program, When Not to Trade Emissions. Look, if you're running an emissions desk, you already know that the decision to stand aside and do absolutely nothing is just as critical as the decision to execute a trade. But here's the real question. Are you standing aside for the right reasons? Let's find out.
Just to quickly orient us, remember we're on a sequenced journey across 9 modules and 110 chapters. That's not counting Module 00, our primer annex, which sits before Chapter 1. Today we are landing squarely in Module 1, Chapter 6, building directly on everything we've established about the 2-book control set.
Okay, before we go any further, we have to lock in this foundational rule. For the compliance book, the statutory surrender deadline is a gate, not a cost. It has a status, not a distribution. It cannot be hurried, and you absolutely cannot trade it off against a commercial return. If you're on the speculative desk, sure, you're trading a view. But on the compliance desk, you are fighting a statutory gate. Keep that dual lens in the back of your mind as we go through this.
So here's exactly what we're rigorously testing today: liquidity and cost, inside information, unfirm quantity, and buying the option to wait. And finally, we'll see how the compliance and speculative books diverge when faced with all of this.
All right, let's jump right in with our first section, the rejected excuses, liquidity and cost.
Desks love to claim that the market is just too thin to absorb a hedge, right? But let's get real and look at the actual numbers. Our entire $750,000 allowance shortfall for the year is just a tiny, tiny sliver compared to the nearly 50 million tons trading on exchange every single day. When a trader says the market is too thin, the math simply does not back them up.
To put that into perspective, that entire annual shortfall makes up exactly 1.5242% of a single day's average on-exchange volume. Aggregate liquidity is absolutely not the reason your desk is standing aside. If someone is claiming it is, they are likely just hesitant to cross a spread or they don't like the price. And from a governance standpoint, that real reason needs to be audited, not masked as a liquidity problem.
What's actually happening is this. Executing just one single tranche of about 17,000 allowances is over 4 times the average off-exchange ticket. So your real constraint isn't market depth at all. It's the risk of signaling your predictable execution schedule to a very concentrated set of counterparties. That's a totally valid concern, but it means you need to vary your fill pattern, not completely halt your trading.
Then we have the second favorite excuse: execution cost. Look at the reality of closing the gate. It costs 51 million euros. Contrast that with crossing a standard 2-cent bid-ask spread on your entire $750,000 shortfall. That costs just 15,000 euros.
We are talking about an immaterial 0.0294% of the position value. Think about it. A desk that hesitates over 15 grand in execution costs while carrying a massive unhedged residual that could swing by €1 million if the market moves just a bit. Their risk priorities are dangerously inverted. Cost is just not a valid reason to stand aside for benchmark contracts.
Section 2. Moving on to a legally upheld reason: inside information.
With the myths out of the way, let's look at something that survives scrutiny. Every compliance desk faces this specific blackout window. Between submitting your verified emissions report on March 31st and the Commission publishing aggregate data in April, you are structurally an insider. You hold a piece of the puzzle that the whole market is waiting for, and that piece moves prices.
This pulls us right into MAR compliance. If your group emits over 6 million tons, you triggered the threshold to be an EAMP, an emission allowance market participant. The regulation says you have a legal duty to publicly disclose that inside information, which then clears the way for you to trade.
But here is the massive trap for smaller operators. Our reference installation sits at about 1 million tons, roughly 16.8% of the threshold. You don't have a duty to disclose, so you skip the paperwork. Awesome, right? Wrong. Being below the threshold doesn't magically remove the prohibition on insider dealing. Because you lack a regulatory public disclosure route, your absolute only compliant option during this window is to abstain from trading entirely.
Section 3. Another valid reason, unfirm quantity.
This is a deeply operational one. You simply cannot execute a fixed hedge if your obligation is a moving target. Maybe your free allocation isn't finalized until June 30th. Or, as we saw back in Chapter 3, a tiny fuel switch gap can violently swing your total obligation by over 57%. But pay close attention here. You only defer that contingent portion. You absolutely still have to execute your core 42.8% no-regret baseline. You can't use forecast uncertainty as a blanket excuse to halt the whole program.
So we have upheld reasons for standing aside, but all of this assumes you have one massive luxury. Do you actually have the operational time to wait? Section 4. Let's talk about buying the option to wait. We need to crunch the numbers on your execution window. If you're operating at a baseline granted authority of 43 tranches, your required schedule consumes the entire 131-day window. You leave zero slack. Which means wait is literally not an available action, no matter how good your reason is. Compliance has to step in and say, we don't have the days left. But if you step up to an optimum authority of 32 tranches, you suddenly buy 33.5 days of slack. Your delegated authority isn't just permission to trade, it is buying your desk the operational option to wait.
And the cost of exercising that option changes drastically depending on where you are. In the EU, missing a primary auction sets your schedule back less than 2 days. In California, primary sales are quarterly. Missing one sets you back over 91 days. It is 53 times more expensive to stand aside in California. If your global group policy treats a do-not-trade decision the same across both markets, you're calibrating to the wrong calendar.
Section 5. Let's bring this all back to the compliance versus speculative desks.
We've been weaving this dynamic in, but let's make it explicitly clear. The exact same market event forces these two books to act completely differently. If a major announcement is imminent, the speculative book can just stand aside. Doing nothing is a perfectly valid position when you're trading a view, but the compliance book, it cannot halt. The statutory surrender deadline is a gate, and that gate does not pause for announcements, and it doesn't pause for anyone.
Because these decisions are critical, your ETRM system has to be smart enough to capture them. An ETRM that only logs executed trades is failing your desk. It must log the specific reason codes for why you abstained. Without reason codes, traders can easily mask those bad liquidity and cost habits as valid compliance decisions, and you won't have the audit trail to prove otherwise.
So, I'll leave you with this provocative thought to take right back to your trading floor. If your desk decides not to trade today, are you exercising calculated, legally grounded risk management? Or are you just falling irreversibly behind a surrender schedule that you simply cannot recover? Think about it, because answering that honestly perfectly sets us up for our next explainer in Chapter 7, where we tackle exactly how to execute those necessary trades effectively. See you there.
Welcome back to our Explainer series for the Emissions and Carbon Trading Desk Master Program. If you're joining us to master the actual hands-on mechanics of carbon markets, you are in the exact right place. Today, we're stepping directly into the shoes of a Durga Analytics consultant, and we're tasked with a critical mission: optimizing your trading desk's operational survival.
We've got a highly focused agenda for this explainer. First, we'll run through the master program context, then tackle the control framework bloat, and dig into compliance versus speculative divergence. After that, we're going to uncover the invisible arithmetic path, solve for the minimum, and finally, give you concrete desk actions for Monday.
All right, let's jump right into Section 1.
master program context, and grounding the desk.
Just to set our bearings on where this specific operational whodunit fits into the big picture, remember, this master program is a sequence journey across 9 modules and 110 chapters. Module 0 acts as our primer annex, numbered 0.1 through 0.14. That sits before Chapter 1 and is not counted in the 110. Right now, we're deep into Module 1, Chapter 7, and what that means is we've already accumulated 6 chapters worth of heavy, totally justified control requirements that, if we implement them blindly, are quite frankly about to break our desk.
Moving on to Section 2, the control framework bloat. Let's count what's actually accumulated. Let's talk about a very real danger on any desk. A control framework that nobody actually implements? It's honestly worse than having no system at all. You're just building a paper trail of your own negligence. It produces a documented expectation that your desk will visibly fail. If we inventory the output from chapters 1 through 6, we find our desk has somehow accumulated a staggering 45 separate controls. Each one made total sense when we introduced it, but read all together, this list has become administratively impossible.
But wait, the operational reality is actually much worse, because 12 of these controls have to be calibrated differently for the compliance book versus the speculative book. Those 45 controls actually require 57 separate system builds. Think about it. A divergent control is, in practice, 2 controls. That right there adds a massive bureaucratic overhead of nearly 27% to your ETRM architecture.
Now here's a massive structural asymmetry you really need to understand. Out of those 45 controls, absolutely 0 of them are speculative only. Every single control we had to add was made necessary by the compliance obligation. Standard trading desks already have limits and stops for their speculative views. The statutory compliance obligation, that unyielding, hard requirement to surrender allowances, is the true source of our incremental control burden.
Which brings us to Section 3, compliance versus speculative divergence, or gates versus returns.
To really get why this bloat happens, we have to look at the very foundation of why you hold these positions in the first place. This is absolutely crucial. The compliance desk holds a position against a rigid statutory surrender gate. It has a status. It is not a distribution. This gate cannot be traded off against a return, and you cannot hurry it up with commercial urgency. The speculative desk, on the other hand, holds a view against a return. Because of this fundamental difference, regulatory changes or market events frequently push these 2 books in complete opposite directions. The exact same event hits them in wildly divergent ways.
Making matters even more precarious. When we look at enforcement, only about 24% of our bloated 57 implementations can actually block a bad action automatically via an ETRM system. Over 44% require a physical person to intervene. And because these manual controls are low frequency, they quietly just stop happening. People forget. They lapse without a signal, leaving your desk completely exposed.
All right, Section 4, the invisible arithmetic path, otherwise known as the silent exposure.
So you can't just hack away at controls randomly to save money, you have to map the crossing paths. That means figuring out the exact ways exposure physically moves between the compliance and speculative books. Our analysis identified 5 crossing paths. 4 of those paths are triggered by transactions. Somebody actually has to execute a trade or push a button. But one specific path, it requires no trade, no management approval, and no rogue actor whatsoever. Let's look at how over 29 million euros can just cross between your books completely undetected.
Well, we call this the arithmetic path, and honestly, it is a massive hidden danger. It's the route by which exposure shifts simply because the underlying emissions forecast changed while your static hedge sat there, entirely idle. The forecast moved, the hedge didn't, and suddenly millions of euros in exposure have silently crossed between your compliance and speculative books. No trade approval rule will ever catch this because, well, no trade happened.
This completely illustrates why latency is just as critical as coverage. Let's say your chief operating officer went with the absolute cheapest control, say a manual monthly review. Under that setup, that massive 29 million euro exposure sits completely undetected for 21 working days. But if you upgrade to an automated daily recomputation rule, your latency drops to 1 single day.
Let's fix this in Section 5, solving for the minimum or building the covering set.
Instead of blindly slashing controls just to hit some arbitrary budget number, we're going to reframe this as a mathematical coverage problem. And a coverage problem has an exact solution. First, we look at what the regulators already enforce for us. California's CITSS system already tests holding limits. The EU Union Registry enforces trusted accounts and the 4 Eyes principle. So we intentionally stop building internal redundant ETRM system checks for the paths the regulator already guards. But notice what both regulators are completely blind to? You guessed it, the arithmetic path.
By relying on the regulators for external transfers and targeting only the actual crossing paths internally, we can slash those 57 implementations down to a vital, covering core of just 5 essential controls. These 5 controls, which are centered around forecasting, tracking activity, monitoring the hedge ratio, and critically, the daily automatic recomputation of that ratio, cover every single path. That is a highly satisfying 91% reduction in framework bloat, all while entirely neutralizing that silent arithmetic threat.
Finally, Section 6, Desk Actions for Monday. Let's implement the fix. Theory only matters if it actually changes how you run your book, right? So here's the exact operational playbook to deploy the minute you sit at your missions trading desk on Monday morning. Start by translating your pros policy documents into raw data, so you can map exactly which of your dual-calibrated controls cover which specific crossing paths. Count your implementations, not your controls on paper. And hey, if your list of crossing paths only has 4 items on it, you've missed the arithmetic one.
Next, you absolutely must upgrade your arithmetic path checks to daily automated rules to completely kill that 21-day latency. Put a lapse detector on any manual controls that remain, because annual controls that fail silently for an entire year. And formally document what the registry handles so your ETRM system stops doing redundant work.
Ultimately, most cost-cutting exercises in trading operations fail because they optimize for a smaller number. And honestly, the smallest set optimizes the completely wrong thing. You have to defend your reduced control set based on coverage and latency, measuring the sheer speed at which crossing exposures are actually caught.
Because remember, at the end of the day, it is your responsibility to manage the compliance gate, not just the cost. A statutory surrender deadline is absolute. You must ensure that your slimmed-down framework leaves absolutely 0 paths unmonitored. So when you're inevitably asked to cut the budget, what's your approach going to be? Random cuts or mapped paths and measured latency?
Now that we've locked down our control points and completely neutralized that tricky arithmetic path, it is time to look at what happens when things really go off the rails. Join us next time in Chapter 8 as we assemble the failure modes and trace exactly how these mechanisms physically compound when an emissions desk actually blows up. Because as we just saw, the biggest threats to your desk are often the ones moving while you sit completely still. See you in the next explainer.
Hello, everyone, and welcome to this explainer. I am your host, and today I'm putting on my Durga Analytics consultant hat. That means I'm pulling from my experience running compliance books against statutory surrender deadlines, managing speculative carbon books against review, sitting on both sides of the auction and bilateral trades, and designing the ETRM systems that actually hold all these allowances, offsets, and registry positions. We are in Chapter 8 of the Emissions and Carbon Trading Desk Master Program. We've spent our last 7 chapters diagnosing individual faults across carbon desks. But today we are completely flipping how you look at operational risk. Here is a quick look at our agenda. We're talking about symptoms versus root causes, the ungoverned classification trap, the actual anatomy of a desk failure, And finally, why regulators cannot save you. We're shifting from treating isolated operational symptoms to diagnosing the underlying structural diseases that truly cause carbon desks to fail. Section 1. Welcome to Chapter 8, Context and Foundation. Let's get grounded before we get into the weeds. As a quick reminder, this master program is a sequence journey across 9 modules and 110 chapters. And remember, that doesn't count the primer annex, modules 0.1 through 0.14, which sits right before Chapter 1. Today, we are deep into Module 1, Chapter 8. In Chapters 1 through 7, we ended every single session by listing all the ways things go wrong. Today, we are finally synthesizing those failure mode tables. Okay, let's dive into this. Notice how the 50 failure modes we've invented so far are distributed across our first 7 chapters. Look at that distribution. It's almost perfectly flat. They're totally evenly spread. And honestly, this is exactly why no single chapter could reveal the true pattern on its own. If you just look at one area of your desk, like execution or valuation, you just see this random, unconnected list of errors. Section 2. Symptoms versus root causes. The illusion of thoroughness. It's time to debunk a massive operational myth. What's really fascinating about how those 50 modes collapse is this. When we classify every single mode by the structural cause that literally had to be present for it to occur, those 50 failure modes trace back to just 7 root causes. Look at the steep curve here. The top 3 roots alone make up 58% of our entire inventory. This leads us to a really eye-opening piece of math. If you assess 50 itemized modes, assuming each one is 95% sound, the probability that your whole desk is sound is a dismal 7.69%. But if you assess the 7 actual roots, your implied confidence jumps to 69.83%. To put that into perspective, that is a massive 9.08 times difference. Assessing 50 individual items isn't just exhausting for your team. Mathematically, it's just the wrong question. So, the absolutely crucial takeaway here is this. A remediation program organized by mode creates 50 separate work streams. That just produces 50 tiny band-aids that treat symptoms while leaving the actual underlying disease alive and well, just waiting to strike again. A program organized by root has 7 work streams and actually cures the desk. Section 3, the ungoverned classification trap, the core disease. Let's look at the deadliest issue on your desk. Out of our 7 roots, 2 of them appear in every single chapter: ungoverned classification and no assessment or no record. Together, they account for 42% of all errors. Because they show up across entirely unrelated subject matter, from your accounting ledgers all the way to Registry Authority, they are proven structural properties of how the desk is built. This isn't just bad luck. To really understand why this is so deadly, we have to look through our primary operational lens. Your compliance desk holds a position because of a statutory surrender obligation against verified emissions. Your speculative desk, on the other hand, holds a position because of a view. A single market event will frequently push these 2 books in completely opposite directions. If your ETRM system cannot mathematically distinguish between a statutory obligation and a speculative view, you are absolutely suffering from ungoverned classification. Let's define this formally. Ungoverned classification means the purpose, entity, or instrument class is not carried as a controlled field, or its transitions are not governed. This single disease represents 24% of all failure modes. Remember this golden rule of system design. A system control cannot branch on a distinction that the underlying data does not carry. If the system doesn't know why you hold an allowance, it literally cannot apply the right limit to it. Section 4, Anatomy of a Desk Failure. The chain reaction. Let's see how these roots stack up in the real world. And this brilliantly illustrates what a real disaster looks like. We're looking at a constructed 5-link chain that results in a 29.12 million euro ungoverned exposure. What makes this utterly terrifying, and which should honestly keep risk managers awake at night, is that every single individual link in this chain was entirely defensible at the time it happened. Let's walk through it together. First, the forecast obligation isn't recomputed after a market move, leaving us with a stale input. Because it's stale, the hedge blindly stays at 100% of the old forecast. Then the asset switches, meaning over 400,000 EUAs are suddenly no longer needed for compliance. But the excess isn't reclassified, it just sits there hiding in the compliance book. The result? 29.12 million euros sitting completely ungoverned by any market limit. Nothing was miscalculated because nothing was calculated in the first place. To make matters even worse, a chain like this is usually only detected at the monthly review, up to 21 working days later. On a carbon desk, we must always remember that a statutory surrender deadline is a gate, not a cost. It has a status rather than a distribution. It absolutely cannot be traded off against a return, and it cannot be hurried by commercial urgency. Being 21 days late on a compliance realization is fatal. Now, you might be thinking, well, a 5-link chain is just incredibly bad luck. It really isn't. Look at the root pairs available for chain formation right here. 85.71% of possible pairs already co-occur in our inventory. A desk doesn't need to be badly run to produce a multi-million euro chain reaction. It simply needs 2 ordinary tolerated weaknesses in the same area to blow up. Section 5. Regulators cannot save you. The reality check. Let's clear up a very dangerous misconception. I often ask desk operators this exact question. Will the registry catch this error? Way too many traders and risk managers blindly rely on regulatory transaction approval as evidence that their internal controls are robust. But is that actually true? Let's break down the reality here. 5 out of our 7 root causes are completely invisible to registries. A registry cannot possibly know that your internal shortfall forecast is stale. They can prevent a mathematically bad transfer, sure, but they absolutely cannot prevent a perfectly formatted, good transfer made against a fundamentally stale or misclassified internal input. The regulator does not govern your ETRM. So, what must we do? Here are the mandatory ETRM implications for any serious emissions desk. You absolutely need input versioning, governed class fields, and incident chain modeling. But if you take away just one thing today, it's this. Add a root classification field to every incident and near miss report. It costs 30 seconds to fill out, and it forces your team to diagnose the actual disease rather than just band-aiding the symptom. I want to leave you with this final, provocative thought. A desk does not need to be badly run to produce a chain. It just needs 2 ordinary weaknesses in the same area. So, how many ordinary weaknesses are you tolerating on your desk right now simply because they haven't linked up yet? Think deeply about that as we wrap up Chapter 8. We are going to take these structural lessons and apply them to real-world desk behaviors in Chapter 9. Thank you for joining me, and I'll see you in the next explainer.
Welcome to this explainer. I'm your host, a consultant from Durga Analytics. I've spent my career running compliance books against hard statutory surrender deadlines, and on the flip side, running speculative carbon books against a market view. We design the ETRM systems that hold these positions, and we teach traders, risk managers, and operators how to navigate this incredibly specific market. Today, we're going to fundamentally shift how you view escalation rights on a carbon desk. We're moving away from the illusion that every blockage can be solved by simply calling a senior manager and moving toward implementing math-backed solutions long before those statutory gates close. Just to ground us, remember our overarching emissions and carbon trading desk master program spans 9 modules and 110 chapters.
That's not counting our Module 00 primer annex, numbered 0.1 through 0.14, which sits right before Chapter 1 and isn't counted in the 110. Today, we are deep into Module 1, specifically Chapter 9, establishing what really binds your desk.
So, here's our roadmap for this session. We'll be looking at limits versus statutory gates, the actual math of escalation, zero Slack emergencies, why you absolutely need to pre-authorize rather than escalate, and finally, the stark scheme realities between California and the EU.
All right, let's jump into Section 1, Limits versus Statutory Gates.
Look, using the exact same word for a limit and a gate is just a fatal governance defect on any trading floor. Think about it. On a speculative desk, you're holding a position because you have a view on the market, right? Your constraints are limits set internally by the firm. So an override here is just a permitted decision that expresses risk appetite. But a compliance desk holds a position because of a statutory surrender obligation against verified emissions. An override against a regulator-set statutory gate, that's a compliance breach. It is not revisable by anyone, no matter how high up the chain they are. The surrender deadline is a literal gate, not a negotiable cost, and you absolutely cannot trade it off against a commercial return.
When we actually sit down and inventory the 24 constraints a Carbon Desk operates under, you'll find that only 6, literally exactly 25%, are the firm's own internal limits that you can actually override. The other 75%? They're statutory, infrastructure, or hard market facts. What this means in practice is that a blind corporate just escalated policy points your trader straight at a brick wall 3/4 of the time. Calling a senior manager simply cannot change a regulatory deadline.
Which brings us to Section 2, the math of escalation.
For that 25% where escalation is actually the right move, let's price it out. An escalation right is literally only worth the probability that the person you're escalating to actually picks up the phone. When you factor in leave, travel, and endless meetings, we model an 84.92% availability for a specific named individual. And here's the kicker. Each step on this escalation ladder costs 2 working days. 2 days. Keep that massive time cost in mind, because remember, on a compliance desk, time cannot be hurried by commercial urgency. The clock is ticking.
Now watch what happens when you tweak the language. By simply changing your policy language from and to or, meaning you name deputies so that any one of 3 specific individuals can act, you shoot your success rate up to 99.66%. That is a huge operational gain for tweaking one sentence. But if your policy requires a ladder of 3 people to all concur, oh man, your chances plummet to a disastrous 61.24%. You're basically setting your desk up to fail.
Let's move to Section 3, Zero Slack and Emergencies. At the granted delegated authority of 1.20 million euros, which we analyzed back in Chapter 6, the desk's approval schedule consumes the entire window. The desk has exactly 0 working days of slack. 0. That means you can afford exactly 0 2-day escalations. Think about it. If you have an escalation right on paper but literally 0 days to actually execute it, you don't really have an escalation right, do you? It's completely unexercisable in the real world.
So what happens when the system breaks? If that 43-step approval chain fails late in the window, and by the way, there's a 35.09% probability of that happening, the desk is suddenly staring down an unplanned massive override of 25.80 million euros. To put that in perspective, that is over 2 times the entire annual risk budget. And it arrives exactly when time is up. The gate is right in your face, and statistically speaking, your boss is probably on an airplane. This is the nightmare emergency nobody plans for.
Moving to Section 4, pre-authorize, do not escalate.
Because the statutory surrender deadline is an unmoving gate, you simply cannot solve the 25 million euro emergency under frantic time pressure. You have to design the solution before you ever need it.
We solved this operational nightmare by converting that late-stage panic request into a pre-authorized standing gate completion authority. Instead of an emergency €25.80 million, we designed a pre-authorization of €13.50 million. Why that number? Because it's exactly the Chapter 5 gate readiness reserve. It's smaller because a facility that can be used early needs to be way less generous than one that is only tapped when you're late and desperate.
To safely govern this pre-authorization, it has to have 4 very distinct properties. First, a dated trigger stated as a clear mathematical test, so it fires automatically without needing some ad hoc committee meeting. Second, it has to have a fixed size denominated in actual exposure units. Third, and this is absolutely crucial for oversight, you must separate the executor from the notifier. They cannot be the same person. And fourth, it requires an automatic report to the risk committee, but only after exercise. This completely shifts the control from seeking permission, which wastes time you don't have, to strict accountability.
Finally, Section 5, Scheme Reality, California versus the EU.
Just to prove this isn't some purely theoretical desk modeling, let's look at how actual regulatory schemes handle missing a gate. On a carbon desk, you have to treat regulatory change as a first-order exposure that sets the price, not just some side scenario. Look at California versus Europe. California Cap and Invest actually built an override directly into their scheme. They set a fixed price ceiling of $102.52 for 2026, bounded strictly by the unfulfilled obligation. Anyone can use it without permission. The EU, on the other hand, absolutely no override mechanism exists, only an unbounded penalty. The absolute most critical difference here is the concept of discharge. In California, paying that expensive ceiling price actually satisfies your statutory obligation. You pay it, and you're done. But in the EU, the EU hits you with a massive €25.20 million penalty. And they still force you to surrender the allowances. The penalty does not discharge the obligation. This terrifying asymmetry right here is exactly why internal pre-authorization is absolutely mandatory for any European compliance desk. The scheme itself gives you 0 escape valves.
I want to leave you with this final, really critical thought to assess your own operations. Does your desk rely on an escalation policy that doesn't actually exist in the regulatory math? Since we now know beyond a shadow of a doubt that pre-authorization beats escalation against a statutory gate, how do we properly govern this sweeping authority without creating a completely different kind of operational risk? Well, that is exactly the question we're going to tackle head-on as we transition into Chapter 10. Thank you so much for joining this explainer, and I'll see you in the next chapter.
Welcome back to the Emissions and Carbon Trading Desk Master Program. I'm your Durga Analytics consultant, and today I'm taking you through a real-world explainer on how to extract actual, actionable lessons from historical market failures. If you're sitting on a real trading desk, building out ETRM systems, or running risk models, you absolutely need a specific lens to look at these events. Today, we're figuring out how to read the public record of desk failures without falling into the massive traps hiding inside them.
Just to ground ourselves in the overall journey, remember our course spans 9 core modules. We started with the foundational primer annex, which is chapters 0.1 through 0.14 of Module 0, and that sits before the main count. Then we moved through modules 1 to 9, covering everything from running a desk and market structure through senior trading playbooks, valuation, risk and credit, execution, ETRM systems, regulation, all the way up to desk leadership. Today, we're officially wrapping up Module 1, Chapter 10. This is our capstone on desk accountability before we dive into market structure. Here is our masterclass agenda for today. We'll start with what we call the numerator trap, then look at Case A on California offsets and Case B on EU registry thefts. After that, we'll compare the compliance versus speculative desk impacts and wrap up with desk controls and tests. Let's get right into it. Section 1. The numerator trap. Why lists of failures cannot measure failure rates.
Here's an overarching thesis you literally have to understand when running a real desk. Published case studies are selected entirely based on their outcomes. Think about it. When something goes horribly wrong on a desk, there's a big investigation, a detailed report, and a public record. Boom, there's your sample. But what about the desks that ran the exact same mechanisms, had the exact same operational gaps, but just survived? They aren't investigated. They aren't counted. It's kind of like trying to figure out how dangerous flying is by only counting plane crashes, without ever knowing how many flights take off safely every day. The public record is just a numerator with absolutely no denominator. It tells you what happened, but it tells you nothing about how often it happens. So, counting these historical cases tells you zilch about frequency. A documented case really only proves that a specific failure mechanism actually exists in the wild. Its true value isn't giving you a probability to plug into a spreadsheet. It's justifying a control test for your own daily operations. As we like to say, a case cannot tell you whether your desk is exposed, because that is a test you run rather than a fact you read.
Which brings us to Section 2. Case A, California offsets. This is a rare scenario where that missing denominator is actually published.
Let's rewind to May 2014. The California Air Resources Board proposes the invalidation of a massive chunk of offsets. The headline number? 231,154. And here's the crazy part. They didn't fail because of some fake carbon reduction scheme. The environmental reality on the ground was perfectly valid. They failed because of a totally unrelated facility operating permit in another state. For a compliance manager, this is literally your worst nightmare. You nail the carbon facts, you do your job perfectly, but some ungoverned classification on a random permit completely voids your compliance instruments.
But you've got to look at the gap between the initial headline and the actual cleared outcome. That 231,000 figure, that was just a preliminary determination, and it absolutely panicked the market. But fast forward 37 days to the final determination. Only 88,955 offsets were actually invalidated. That's a massive drop. If you were sizing your desk's risk based on that initial headline panic, you overstated your exposure by a factor of 2.6. The lesson? Always read all the way to the final determination.
Now, because California actually published the 35 million unit buyer liability pool, meaning we finally have our missing denominator, we can actually calculate a base rate here. This single event represented a microscopic 0.25% of the total exposed pool, yet it made up a whopping 82.5% of every single invalidation in the entire history of the program. The historical record is basically just this one isolated event. And this hyper-specific data is exactly why the private market stepped in and developed invalidation insurance to reallocate that risk.
Let's pivot to Section 3. Case B, EU registry thefts. This is a prime example of where the denominator completely does not exist. We're looking at the 2011 EU registry thefts, and this is where the public record loves to manufacture precision. You'll see 4 totally different loss figures published for the exact same event. We're talking anywhere from 7 million to 45 million euros. Why? Because reporters are mixing up the scope, the dates, and even the currencies. As a professional desk, your risk control methodology has to be to preserve this messy published range, state exactly why the figures differ, and never ever blindly adopt just one of these numbers into a hard, fast risk calculation. But the real operational gold hidden in this case isn't the financial loss at all. It's how the regulator actually responded. After the thefts, the European Commission stepped in and halted transactions for 91 straight days. The market froze. But, and this is an absolutely massive operational detail for us, they expressly preserved allocation and surrender. So transfers between accounts stopped completely, but the compliance gate, that stayed wide open.
And this proves a core philosophy we've been hammering home since Chapter 1. Surrender is a gate, not a cost. It's a statutory status. You can't trade it off against a financial return, and you can't rush it with commercial urgency. If you modeled your compliance exposure like a tradable position, you'd see a 91-day market suspension, panic, and wrongly assume you couldn't comply. But if you modeled it properly, as a gate, you'd realize you were totally fine. You could just calmly discharge your statutory obligation straight from the inventory already sitting in your account. Section 4. Compliance versus speculative. How the exact same mechanism inverts based entirely on your book.
When you're sitting on a real desk or managing an ETRM system, you realize pretty quickly that the primary axis completely inverts between these two historical cases. A single shock to the market will frequently push a compliance book and a speculative book in two totally opposite directions. Let's walk the reality through both desks. In the California invalidation case, the compliance desk was bleeding. Because of buyer liability rules, they had to actively scramble back into the market and buy replacement units just to stay covered. The speculative desk? They were fine. It was just a financial position. They took a markdown and exited the trade. But flip over to the EU registry suspension and the roles completely reverse. The speculative desk was trapped in a spot position they literally couldn't touch for 3 months. Meanwhile, the compliance manager, they just ignored the spot market freeze entirely and walked their existing inventory right through that open surrender gate. Same exact shock, completely different survival outcomes.
Finally, Section 5. Desk controls and tests. Reading the record honestly.
So how do we integrate these lessons into our ETRM systems and risk models? Your controls have to enforce an honest reading of the public record. First, always wait for the final determination to avoid headline inflation. Second, never ever cite a base rate or calculate a probability if you don't have a published denominator. Third, extract the actual regulatory mechanism, like whether transfers or surrender were halted, rather than just copying down a raw financial magnitude. Fourth, preserve published data ranges instead of inventing precision. And most importantly, always convert the historical case into a practical operational stress test for your own infrastructure.
I'm going to leave you with one vital test to run on your own ETRM setup today. If transfers into and out of your registry account stopped tomorrow and did not resume for 3 straight months, could you still surrender? The answer is purely a function of how much inventory you already hold in the correct account, and it is entirely knowable right now. Answering that question honestly with your risk managers is exactly how you survive a market failure. Think about it. Next time, we kick off Module 2 and finally begin tackling emissions market structure. I'll see you there.